Hello and welcome everyone to the Wall Street Blockchain Alliance's special global webinar, the tokenization of real-world assets, presented by WSBA member firm Texture Capital. My name is Ron Quaranta, chair of the Wall Street Blockchain Alliance. It's a pleasure to be here with you all. The ability to tokenize assets has long been considered one of the primary use cases for blockchain technology. Join our industry experts for this really enlightening conversation about the tokenization of real-world assets, possibilities that this innovation allows for, challenges to implementation, regulatory issues, and much more. Before we begin, a little bit of housekeeping for today's session. Please do keep in mind all attendees will be in listen-only mode. And attendees, obviously, you're encouraged to submit your questions in the Q&A chat. We'll reserve some time at the end for our panelists to answer those. Please also keep in mind that this event is offered for general information purposes only. Nothing discussed is meant to be accounting, investment, legal, or tax advice, and any views expressed during the event are those of the participants, don't necessarily represent the Wall Street Blockchain Alliance or they're necessarily their firms. Well, with that said, let us kick off. I want to give our panelists and industry experts an opportunity to say hello. So I'll go around the horn a bit. Jay, we're going to start with you. Say hello, please. Tell us about yourself and the firm.
Sure, JV Alcamano, digital assets at State Street. I've been at State Street for 6 years now, and I'm looking forward to the panel.
Excellent, Jay. Good to see you again. Gerald.
Hi, everyone. Glad to be here. My name is Gerald David. I sometimes go by JD. I work at a company called Arca. I'm the president of Arca Labs, which is the innovation arm of Arca. And we're focused on creating products and services that harness the transformative power of blockchain and also have the goal to advance the financial system. We created the first 40 Act fund that issues its shares as digital asset securities, and looking forward to sharing more with the group today.
JD, good to see you, buddy. Mr. Johnson, old friends, please say hello.
Hey, good to see you again, Ron. Everyone, thanks for joining. My name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA and SEC registered broker-dealer focused on the tokenization of securities and real-world assets. We help clients compliantly raise capital through security token offerings for equity, debt, revenue share, royalties, and other investment contracts. And we have an ATS for secondary trading. We support a diverse range of asset classes from traditional finance to alternatives to Web3. And we also offer a white label solution for those folks who want to operate their own tokenized marketplace.
Gents, good to see you all. Thank you. I want to kick off. Richard, let's start with you. If we
I think we missed Anthony here on the intros.
Oh, Anthony, I'm so sorry. Mr. Morrow, please say hello.
Yeah, last but not least, that's okay.
Never.
Best for last.
So nice to see everybody. I'm Anthony Morrow, CEO of Provenance Blockchain Foundation and Provenance Blockchain Labs. For those of you who may not know us, Provenance is a public layer 1 blockchain built specifically for financial services use cases. Our power user is Figure Technology, who's tokenized more than $8 billion of real world assets on Provenance. I think that makes us the largest public blockchain in the world by real world assets, total value locked, and really excited for the conversation.
Anthony, next beer at the shore will be on me, my friend. Apologies for that. So I know we've got some slides to kick off. Richard, let's start with you. And I just want to go to this next slide briefly. Earlier this summer, Texture Capital published a really fascinating report, Tokenization of Real-World Assets, Assessing Market Sentiment. What was the impetus for this report? And tell us some of the kind of high-level highlights that you got out of that discussion.
Thanks, Ron. Yeah, so there's been a lot of hype around tokenization of securities and real-world assets this year. At the beginning of this year, we had Larry Fink came out and said he believes the next generation of markets will be tokenization of securities. Then there's been positive reports from Citi saying they expect there to be 4 to 5 trillion of tokenized digital securities by 2030. And we've seen other players such as Goldman and so forth coming out with bullish forecasts for the space. So what I thought was lacking was kind of like, let's try and get a grip on what other folks in the industry are thinking, and create a way for people who aren't as familiar with the space to get up to speed and really get a pulse of what's going on out there. So we conducted this survey of about 40 executives. Some were from native crypto companies, some were from more traditional finance companies. Everyone was kind of in the digital asset space. So we expect we got some kind of well-informed opinions from folks. We looked at what are the kind of challenges, what are the benefits, what are the opportunities, what are the preferred types of real-world assets, and what's kind of the best path forward for adoption. And these are some of the things we're going to get into in this conversation. If you want to download a full copy of the report, you can go to our website. The link is there, and we'll share this as well after the webinar.
Richard, perfect. Thank you so much. I'm going to take us off screen share for a bit. We have other slides later, but I want to give the audience the opportunity to see our subject matter experts. Gents, I want to dive into this a little bit. We've heard the term under tokenization. What do we mean when we're talking about understanding tokenization? It's often been, Richard, you and I have had this conversation for years. It feels like crypto, not blockchain, blockchain, not crypto. But what are we really talking about when we're talking about tokenization? And let me preface that with one thing. I had a colleague, we talked about this in prep, say, well, Ron, you're just talking about putting a PDF file on a blockchain. I would argue it's a bit more nuanced and complex than that. JD, do you want to kind of start that conversation and we can spread it out amongst the rest of the group?
Yeah, absolutely. And I think that, this conversation is super appropriate right now, because I think, as Richard said a minute ago, I think everyone, when they're talking about their predictions for 2023, RWAs and real world assets was really kind of the buzz term. And I think that it's cool that we get to dive a little bit deeper now and talk about what that really means, and, kind of what that means for the market and what the impacts are and what people have done so far. So I think when people talk about tokenization, generally speaking, it's really about taking, kind of an asset that exists in the real world and digitizing it in a way that it could be transferred, that has some unique benefits to it. And those unique benefits, as we look at it, obviously, are enhancements in transferability and time. And I think that when you take a look at, kind of the use cases that exist for real world assets, and you start thinking about how it is that a blockchain can advance the way that, products exist currently, and you think about things like transferability and time, you can think about how it could be so impactful to the way that flows work currently. We spent a lot of time talking to folks like Jay, who are, kind of working with, real businesses that exist and can actually benefit from this. And we think that, an institutional approach to tokenization could just really, really, really revolutionize the way that the traditional markets have been working. We look at things like, security movements. We look at things like collateral management. We look at things like treasury management. And we start thinking about the way that those instruments that exist in the current marketplace in a tokenized fashion could create super enhancements to the way that markets work, and ultimately end up reducing a tremendous amount of risk because of the amount of time that's involved in the reduction of settlement and the ability to transfer these assets from one wallet or from one participant to another in a rapid way, ultimately increasing efficiency in the markets.
JD, thanks. Jay, if I could go to you, and obviously for the rest of the colleagues on this panel, certainly chime in. But Jay, from the perspective of a firm like yours, what are we looking at when we talk about tokenization? And you and I had a brief prep session where we talked about things like rights and obligations. How are they embedded, or how could they be embedded in the world of tokenization? And how might that benefit clients of State Street?
Well, really, when you think about blockchain, and it's, when you dumb it down, it's validating ownership and be able to transfer value, right? So what do we do every day here? That's what we do when we move assets, whether we're selling assets, whether we're transferring assets. So blockchain allows you to eliminate all that friction in the market. So if you look at, in the traditional market, such as an equity market, most people would say it's fairly efficient, but it takes 2 or 3 days to settle those assets, right? You have to have bank movements. You have to be able to move cash. You be able to get validation. You have counterparty risk. And then when you want to move into another asset class, it starts that cycle all over again. So if you can embed some requirements, or issuers embed requirements inside these assets, you could take the time frame of moving one asset into the other, and that's what JD had already said, like the timeliness of doing this, and do it immediately, right? You can do atomic settlement, and Richard and I have spoken about atomic settlement in previous calls. So when we talk to our clients, they understand that. They see the efficiency that blockchain can bring to the market. But one of the things we're up against is there is no infrastructure to support that at this time, right? So what we're looking at from a State Street point of view is building the infrastructure to support digitized assets, because really we want our clients to be able to move from one asset class to another, but do so in a way where they're completely agnostic to the form of that asset. On the other side of that, I think, the real challenge is to the issuer, right? The issuer has to be able to create an asset that is actually attractive, an asset that can be moved on a blockchain with all the embedded requirements and covenants that you need. And, our clients are looking to us to be able to create that infrastructure, to be able to settle those securities, and to be able to service those securities just like any other securities are today.
Jay, thanks. Richard, Anthony, if you could chime in here. And JD had kind of referenced some of the benefits. I want to get your commentary and then kind of bring up the next slide, Richard, which really speaks to some of the survey results you had seen. But can both of you speak to some of what we're talking about when we talk about this tokenization? And again, we've been participants in markets in a bunch of different capacities. What are those kind of roadblocks to some of those implementations? Or what are some of the perspectives on it?
I think JD and Jay did a great explanation there. I think maybe I'll say what we're not talking about with tokenization is some of the other use cases that I think became very popular around 2016, 2015, which was kind of using blockchain kind of rebranded as DLT, which is a phrase I kind of hate, but rebranded as distributed ledger technology and being used for other purposes like post-trade, for example. There's a litany of failed post-trade use cases for blockchain out there. And the reason I believe, and I said this at the time, in fact, was because what people were doing, they were taking the technology and trying to plug it into another use case. And the reason it worked, for settlement in Bitcoin and Ether and other cryptocurrencies was because the asset was natively digitalized on chain. So that's really what we're trying to do. But the thing we're doing is we're not putting crypto on chain. We're putting actual real world securities with a potential, total market cap of whatever it is, 500 trillion or so out there. That's what we're trying to do.
And I'll double click on that, Richard. I mean, that's exactly the right point. Digitally native securities is absolutely the key. If you take an existing, and I don't like the term real world assets if we're talking about terms we don't like, because if you have a digitally native security, is that a real world asset or not? It's debatable. But if you take a fund that exists in the real world and you own it and then you just tokenize that and then you sell that tokenized stake, it really is double the risk, double the expense. It's really not a good use of blockchain. But if you take a product like a mortgage or a home equity line of credit and you create it digitally native and it only exists on the blockchain, and then you can perfect ownership through a proper registrar, and then you can go through and you can sell or securitize or distribute it to an end investor, now you've taken a lot of the risk, a lot of the time, and a lot of the process out of it, a lot of the intermediaries out of it, and you've made a more efficient security. So it is really security by security type, and not all types of securities are immediately appropriate for blockchain. The public equity market works well. There's a lot of intermediaries, of course, but it generally works well. So we're not going to see that coming out onto blockchain, holistically anytime soon. But if you're talking about home equity lines of credit or mortgages, I think that market's already been disrupted by blockchain.
Gents, thanks very much. Richard, with your permission, I think it's a good time. We've been referencing benefits very broadly. I wanted to bring up the next slide, which I thought was critical to the conversation, which was the benefits of tokenized real world assets. I'm sorry, Anthony, I'll just say RWA for you going forward, but forgive me going forward. Richard, speak to this a little bit and let's get the perspectives of some of our other panelists. Were you any surprised by any of the data points in the benefits survey?
That's a good question. The one I was surprised was the last one, actually. The one that got the low result there, 13%. I thought this should have been higher, but I suppose relative to some of the others, people were, and I think this is obviously, as you can see by the numbers, this is a multi-select. So I think people maybe just kind of down-weighting that, but the 13% saying there's an improved risk return versus crypto native assets is perhaps not representative of the fact of the different risk return profile. What I was getting at there is kind of, when you look at crypto native assets, you've either got kind of the Bitcoins and Ethereums and so forth, which have potentially very high returns or have had, but also very high volatility. And on the other end of the scale, you've got stable coins with no returns, and also no volatility. So it does kind of depend on your individual risk preferences. But a lot of the time, something like a tokenized interval fund like ARCA has, that is number one, stable, and also offering competitive returns for a lot of folks, and we've definitely seen that recently. That is an improved risk return profile, as is potentially private equity, private credit, structured products, et cetera, et cetera. So I'd say that was the one I was kind of a little bit surprised at, but maybe it's all just relative to some of the other answers here.
Richard, thanks. Gents, for those of you who reviewed the benefits, and I'm sure you all read the report, what were your thoughts on the benefit? And I wanted to throw one thing out there, tear up the script just a little bit. I was actually a bit surprised at the high number for ability to use DeFi, given some of the worlds that we come from. Am I misreading that data point? Does anyone have any perspectives on that?
Well, I'll jump in. I think a lot of what we want to do, so speaking for Texture anyway, is harness the innovation in DeFi, but bring it into a regulated securities context. So that's why we went, to the SEC and FINRA back in 2019 to get ourselves registered to do this the right way. So we do see a lot of potential in leveraging things like lending protocols and other types of products, maybe even AMMs at some point, for tokenized real-world assets and securities. So I think it's there. There's definitely some kind of hurdles of doing that right away, which we can kind of get into as well.
I think
that was one of my. I mean, Richard, that was one of my main observations as well, on the results from this specific question, is that I think that the respondents that were involved in the survey, I think talked about this in an aspirational way, right? So when we take a look at things like, lower cost of asset issuing and servicing, I think that there's probably some costs that are embedded right now that probably have some erosion as we move forward. But I would think that right now, kind of it's probably a coin toss as to whether it costs the same or a little bit of less. And I think that the aspiration is that with critical mass, these costs can get driven down in a way that whereby maybe some of the roles that exist currently won't exist in the future. And I also think that the same thing with reference to, improved liquidity, that's absolutely the aspiration. The aspiration is that there are digital asset securities, ATSs, that are existing and up and running right now. And the hope and the belief is that, kind of with quality products that exist, and with, kind of proven technology, that the liquidity will come. And that liquidity, once it arrives, has the potential to be extremely, extremely disruptive to the marketplace, given some of the products that we're going to talk about, later on in the session.
Yeah, I agree 100%, Gerald. And one of the things I kind of disagreed on, same as you, is improved liquidity, right? We're not seeing it right now. The biggest problem we have in the market is convincing people in the first, that 63%. I'm not seeing that as well. I do think that we understand that, right? We are the cheerleaders for this, technology. However, it's not trickling down to the issuers, at least the quality issuers. So it is aspirational. We do believe that, in effect, that issuers will understand lower cost, and the lower servicing of these assets will be something they should not ignore. But until that happens, that improved liquidity just doesn't exist. I think that's one of the problems that's been in this market for well over 5 to 6 years now, is you're creating these silos of liquidity. But in effect, when investors are invested in these tokenized assets, they're kind of locking themselves in. And until there's a much broader upswell of issuers and investors, and actually centralized locations, right, for people to trade, borrow, do whatever they need to do with these assets like they do in the traditional world, that's just not going to happen. It's happening slowly. I think we're still talking trickle. I just don't see the flood happening within the next 18 to 24 months.
Jay, if we could stay with you for a second, and I appreciate everyone's perspectives. In prep, I think I got in trouble for using the word education. I'm going to use it one last time, but I just want to throw out there, Jay, you mentioned issuers. And again, I think we all agree the critical importance of issuers coming to that table. For you, let's start with you, Jay, and for the others, what are the roadblocks for issuers? We come out of a world, Jay, where it's liquidity begets liquidity. You and I, we all understand that. Can you speak a little bit about what some of the impediments for issuers might be in your perspective?
Well, let's look at the obvious from a State Street custody standpoint, right? So if a quality asset comes out, we do not custody digital assets right now, right? So we've spoken about, we're looking to do that in the future. So if a client came to us and they wanted us to custody, say a bond or an equity or even a private asset, we don't have the capabilities of doing it. And the reason clients come to firms like State Street is not just to put custody assets and put them in the drawer. It's to service them, to do sec lending, right? To do hypothecation. So in effect, those assets right now, there's a barrier for them to be serviced by the traditional banks, right? And in effect, some clients can't use the current custodians, right? And that's why I said they have these silos of liquidity where you have to work with a third party or even a startup to do that. So that's barrier number one. Barrier number two, I do not think the regulations are a barrier, and people that's the obvious, but the regulations are in a crypto market. Really, in traditional markets, it's just a new form, it's a new wrapper. Right. So I don't think that's a barrier. The third part is, it's just the understanding of how these assets are going to be distributed. Right. Distribution is the primary, reason for someone to work with a certain provider, working with a Goldman Sachs or working with a Morgan Stanley, right, to be able to access that institutional liquidity. And in effect, that just is not happening either. So I think there's, it's profound. The custody piece is probably the last part of it, but it's the barrier I think that we see every day, and it's the one thing I think our clients want us to solve, but no one's banging down the door for us to solve it. We have maybe a couple conversations a year with someone looking to get a bond or a tokenized bond, and they're like, we can't service it. We'd like to. We might do a proof of concept, but it's not a groundswell, right? There's not, we don't have the revenue bonds of a Ford or a large entity.
Right. Jay, thanks. JD, I saw you nodding, which to a moderator is cue for a call on me, whether you like it or not, buddy. But I just want to see if you wanted to add anything to that, and then open up for the rest of the panel.
Yeah, while Jay was talking, I was thinking about, kind of the underweightedness, right, of the gateway for TradFi to DeFi. I think that if that question had been phrased gateway for TradFi into digital asset securities, I think that the number would have been far greater. And it was just what Jay was saying a second ago, is that you've got, kind of entrenched financial institutions, many of which are publicly traded. They've got intense risk committees, they've got intense compliance operations, and one small slip up in a custody solution, in a transfer, in a trust of a blockchain, in any of these different elements that were mentioned before, creates tremendous risk, right, for these large scale financial institutions. But when you're dealing with something that they're familiar with, whether it's a bond, whether it's a treasury, when you're dealing with something that simply has a wrapper, so to speak, as Jay mentioned a second ago, that's put on an asset, all you're doing is changing, the delivery mechanism. You're not changing the provenance of the actual asset. You're not changing, anything about it whatsoever. So it's something that I think that large scale traditional financial institutions can gravitate to because they understand it. And the final point I would make here, Ron, is that in many of these different scenarios, we're talking about registered products. And we're talking about registered products that have the overlay of regulation and are created under different acts of Congress, like the 40 Act or the 30 Act, right? You're dealing with products that are very, very familiar. And I think that that's one of the keys as well, is that the real world assets have an element of familiarity. When you wrap them in a digital asset security wrapper, you're talking about something that's very, very similar to what they know already.
JD, thanks. Before we move to the next slide, Richard, with your permission, I think the preferred RWA is a good talking point at this point. Just wanted to ask if you or Anthony want to add to the benefits conversation. Any comments there?
Yeah, maybe I'll throw in there, again, we're talking in terms of generic securities, but if you talk in terms of specific securities, there are some really good success stories. I think what Broadridge has done with its repo platform, I think the numbers are $1 trillion a month are being transacted on their private blockchain network, of course, but still a big step in the right direction. That market has been disrupted. It is, you don't need tri-party repo anymore if you have two parties that can counteract with one another and settle with one another without the use of a intermediated bank that has to provide that service. And also what Figure has done in the home equity line of credit. That market has already been disrupted. They're doing $400 million a month in HELOCs. And that's a massive number. It's already disrupted the industry. Now, bonds and equities and private equity and some of these other securities that we're talking about are going to take longer, but it's going to come down one asset type at a time. It's not going to be holistic. We're not going to see all the private markets. We're going to see private asset by private asset by private asset coming and transforming industry by industry by industry.
I think one last comment on that. I think Anthony pointed out what he's done and what Figure and Provenance have done with the tokenization of HELOCs. I think that really speaks to the number one bar on this, the lower cost of asset issuance and servicing. Because my understanding, they've really brought the cost down there and they will do it much more efficiently. But I think what there's a trend, or maybe we'll get to this in another slide here. Structured products are a very good use case, and when you look at this and you think about what's the what are the next asset classes that are going to get tokenized, these kind of structured products, which really have a very high cost of asset issuance because they can all be kind of unique and different, have different triggers and so forth, have different types of parties involved in the transactions, they can be very expensive. So you want to start with some of the asset classes where there's the most potential benefit. So I do think this is one of the areas, the more complex products where you can have a digitized, repeatable process, you really be able to bring down costs and demonstrate the benefit of tokenization.
Richard, thank you. And Anthony, let's move to that next slide because I think that's an important consideration when we're talking about preferred RWAs. Richard, I would love to start with you and dive into this a little bit. I don't think either of us were surprised. Certainly I wasn't when we read the report that real estate was the preferred asset, real world asset for tokenization. But some of this smacks in the face of conversations that we've had, certainly at the WSBA, with real estate experts across commercial and residential about the complexity of the real estate marketplace. Richard, can you speak a little bit to that in the survey that you and the company did there? And I'd love to open that up for others as well. Are we struggling with the incumbents overhead associated with some of these assets? And is that one of the impediments to tokenization?
Yeah, again, not surprised by real estate. We see a lot of that out there. One of the very first security tokens was the Aspen coin, which is a real estate product. Our pipeline is probably 58% real estate issuers as well. So that definitely kind of correlates to what we're seeing. I think when it comes to real estate, it is happening. It's a massive asset class. It's very hard for investors to get exposure to it through public markets. You got public REITs, but they're very kind of diversified. So there's a lot of opportunity. There's not a lot of liquidity, so we can improve that. It is happening. There's a lot of stuff going on there. I think the main confusion that happens in the real estate space is that people are like, wait a minute, a lot of things get bucketed in. Is it a REIT? Is it a, are we talking about an LLC type investment? And title is the big one that confuses people, I think, because it's a completely different thing, talking about putting title on blockchain, which is more of a kind of record keeping, source of truth type thing, as opposed to putting a REIT on blockchain, which is more about, or private REIT anyway, more about transparency, liquidity, and some of these other benefits we've talked about.
Well, in real estate, it's important to know you don't own real estate, you own a fund that owns real estate.
Exactly. Yeah.
Anthony, Richard, thanks. JD, Jay, any of the preferred real world asset survey data points, any of that surprise you?
I mean, Jay, I'll take a first pass. That's cool. What what I would say about this when I looked at the results here were that there's an inverse relationship between liquidity and the need for tokenization here, at least in the perceived eyes of the respondents, right? So the least liquid markets, folks are looking for ways to actually access liquidity in it. So we took an attempt at trying to create a tokenized version of a equity portfolio. We thought that would be super interesting, and we could, kind of take, let's say, 5 or 6 different names, put them into a portfolio, and then issue a digitized version of shares of that portfolio. We went out and did market research on that, and we found out that there was minimal appetite for it. Then we started probing and asking people why, and the answer was, A, we've got, fully liquid markets in terms of like NASDAQ and the NYSE here. So why would we need a digitized version of something we can already get for a very, very, very low cost in a very liquid way? And then the other place that we were looking were on the actual attempts that ones have made already in some companies that don't exist anymore to try to tokenize individual names. And for most of those names, there was low levels of liquidity there. So when I look at this, like I said, I look at this as being an inverse relationship, and folks that are looking for new ways to access markets they can't have access to, and through digitization and through tokenization, perhaps they can.
JD, thanks. Jay, anything you want to add? Then I'll bring us back to seeing everyone's faces for a moment. But
sure. So I'll address what we're seeing from our clients. So certainly real estate, private company shares, private equity funds, and private credit are probably 3 areas we've had the most conversations with clients, right? There's preference there because we know tokenization can help in liquidity and servicing, et cetera. So we have had several clients even come to us like, listen, I want to buy some real estate tokens. Could you refer me to some? The conversations got that pedantic. Where we've had some interesting conversations is in the alternative assets. And being at State Street, we get a lot of inbound calls, firms looking to do things around alternative assets. And when you talk to the institutions, they're like, listen, these alternative assets, certainly in fine art, come to mind, but they're like, if I want to invest in fine art, I don't need to share it with 1,000 other people. I will invest directly in that space. So some of these are kind of, interesting, but I don't think from an institutional standpoint, we'll ever get any groundswell support because these are very specific assets that clients, if they want to invest in them, can do already and want to get all the alpha. But the other area is certainly the private equity space, the underlying private company shares. There is a lot of talk with our asset managers. They are invested in them. A lot of times they are locked up in a lot of these assets that they can't find liquidity in, and they want to be able to get more liquidity. And if there's alpha, get some of it out, or move in between investments. So that's really where we're seeing most of it. And then we already know that money market funds have been tokenized. A lot of structured products are tokenized. Commodities, obviously, but yeah, private equities, public equities, certainly a problem. I would even say, if they're tokenized in the next 10 years, I'd be surprised. There's no interest in doing that, and people believe those markets are more efficient than than anything else out there.
Jay, thanks so much. Let's get the audience to see all of our faces again. Jay, I'd love to stick with you for one moment, if I could. I'm going to tear up the script again. You can all yell at me after the webinar. But when we talk about private equities and private shares, I want to ask Jay, and I want to start with you about some of the regulation we've seen coming out of the SEC. We didn't really specifically talk about this in prep. But one of the interesting things that we've seen is the SEC coming forward with new private equity, private market regulations. And I would argue that tokenization might be a benefit to that. Is that an impediment or a benefit, what you're seeing in the regulation space?
It's definitely a benefit, right? So as anytime you have any more clarity from regulators, it offers an ability or offers an opportunity for something to happen, some sort of innovation. So we are seeing a lot of talk around private assets, and the focus, I think, of the regulators right now is private assets. No, it's not private assets tokenized, but actually the ability for private assets to get more constituencies and move into a class where they find more liquidity and clients are actually protected at the end, right? So that's really what it comes down to. The regulator is looking to protect the end client, and tokenization. And I'll be honest with you, I'm not having these conversations directly with regulators, but from what I've heard, from what I've seen, is they feel that it doesn't matter the form of the asset, it matters how the asset is held and how that asset is being able to be transferred and traded and priced, right? And that's what we're seeing. And I think when you apply blockchain to that, it's the perfect use case.
Right. Jay, thanks so much. Before one quick question for the audience. Again, thank you all for joining us. Many more of you are piling in. Please do keep your questions in the Q&A coming. We'll address them towards the end. I'm jumping a little bit ahead, but Richard, Anthony, JD, from a regulatory perspective, what are you seeing in some of this? I know we didn't specifically talk about the SEC in prep, but I certainly want your perspectives. I feel like there's not a day that goes by where we don't have to read something that a regulator said that might impact our world, but we're not quite sure. JD, Richard, Anthony, anything you want to add from a regulatory oversight perspective or regulatory thoughts?
Yeah, just quickly, I think you need to separate securities from crypto. Again, I think every time we answer a question in our industry, we need to separate, real world securities versus crypto. And crypto regulations aren't where they need to be in order to have a properly functioning market. In the security side, though, they're absolutely where they need to be. The 33 and the 34 Acts and Reg D, Reg A plus, it's all there. If you want to issue funds under any of those regulations, you certainly can. It's when you get into the blockchain / crypto aspect of what you're doing is when you have some issues. So are layer one blockchains like ourselves ever going to be considered public securities? And if so, what is the construct for us to register as a public company? There is no clear path for that. And we're willing to do whatever the SEC wants us to do, but there is absolutely no guidelines or guidance as to how a layer one could register as a public security. So those types of things need to be clearer in order for public blockchains to be a material part of the ecosystem.
There are very public comments by very public regulators who would say it's very, very clear, Anthony, but we can all have that conversation.
Yeah, but you can't, the issue there, so one of the issues, just to give you an example of why it's impossible for a public layer one to register, is because you can't pay your validators in your token, which would then be deemed a security unless your validators are all broker dealers. So things like that need to be resolved.
I agree with you. I was only being slightly snarky.
Yeah.
I appreciate it, Anthony. JD, Richard, anything you want to add to that? We have these conversations on a regular basis, but would love your perspectives.
Yeah, I mean, from our perspective, we're a RIC, we're an RIA. We created a 40 Act fund that issues its shares as digital asset securities. And we've been doing this for 5 years.
Yep.
So I think that our take on regulation is slightly different because we've been working with the regulators for such a long period of time in trying to understand kind of where a digital asset security and a digital asset security delivery can fit within the confines of registered products. And we've been slowly working and chipping away at kind of places where we think that there could be efficiencies, trying to work and trying to, kind of educate and work in partnership with the SEC in order to bring those enhancements forward. So we, kind of from our standpoint and kind of piggybacking what Anthony said, when you're dealing with a digital asset security, the rules are kind of pretty clear. We kind of know what those guardrails are and we know how we could operate. And if we believe that there's an enhancement that hasn't had precedent yet set, then we do exactly what you would expect that we do. We go out and we try to make the case. We bring the facts to the regulator. We explain why we think there's an efficiency that can be created, and we see if there's a way that kind of exemptive relief can be offered for us. So kind of I think that there are there are certain cases whereby there have been success stories that have come through regulation, and I like to think that we're one of them.
I'll just add one more thing on this topic. I think we all said at the beginning here, we're not talking about crypto, we're talking about tokenized securities. The thing is that they've been lumped together by the SEC for years now, and I think we are getting to a bit of clarity coming through the courts. If you take kind of the Ripple judgment, which I know it's going to be appealed, but the judge there was saying that XRP itself is not a security, rather the sale of it was the investment contract.
Right.
And I think that, frankly, I'm happy about that, because I think it creates more of a dividing line between what we're trying to do. We were never trying to force layer one tokens to come onto an ATS. What we're really trying to do is use the technology to improve the market structure of capital markets. So hopefully we're getting by kind of, it's not as if like the SEC's regulations around specifically tokenization of securities is changing, but rather the kind of the outlook or the prospects for the crypto regulations, creating more of a kind of dividing line between us, which I think is a good thing.
Richard, well, on that point, real quickly, I found it heartening that the judicial decisions, again, going off script a little bit, but it's part of our everyday for the five of us, were really well considered, well thought out. Would you agree with that? That, these judicial decisions are really based in an understanding of things like blockchain and tokenization?
I think so. I mean, I'll be honest, I didn't read all 3,000 pages of all these things that came out, but from what I've been reading about it, it does make sense, and it does fit with how myself and the WSBA and other folks have been viewing the world.
Yeah. Excellent, gents. Thanks so much. Moving forward a little bit, we talked about I want to talk a little bit about integration points. And I know you just mentioned we're not talking crypto, Richard, but it is an analogy, an analog I want to use. For a long time, we've had this whole crypto is suffering from choke point 2.0 or whatever hyperbole people want to throw out there. Is there a challenge around the integration of the capabilities of tokenization with real world asset providers and the TradFi world that we know? And what are you all seeing in the kind of day-to-day conversation of that? Anthony, I'd love to start with you if you've got perspectives and then spread that out amongst the rest of the group.
Yeah, I mean, I keep coming back to asset by asset because that's how this is going to be solved. It's not going to be done holistically. And yeah, I don't really have much more guidance other than tackle an industry, solve the problem, move on. I think one of the next industries that we're going to see is something that isn't really readily available now in mass is receivables. We're seeing more receivables use cases across the board, and blockchain is a really good use case for that because it does inject an element of trust into what is essentially a three-party agreement. And it considerably removes risk, and that it does do a societal benefit as well in that it lowers rates significantly to borrowers. And if we can do societal good, great. I mean, that's what we're all here to ensure that we're here to foster our businesses and to build new things, but also doing societal good is really nice if you can do that as well. So yeah, I think industries like that we'll see, and we'll industry by industry by industry, and it'll come.
Anthony, thanks. JD, did you want to weigh in on that?
Yeah, I mean, I think that in part it becomes to siloed use cases or like use cases that are done in collaboration with other different counterparties, right? And I think that there's a little bit of a friction that's that exists there because you've got and I'm speaking specifically to kind of large scale financial institutions at the moment. But if you're taking, kind of these institutions who are, competitors in nature, right, naturally, and trying to create the best possible product, but at the end of the day, we'll need to collaborate with their peers in order to create, solutions that manifest across an entire industry. Well, kind of then the actual, entities themselves have to, understand what those rules are in order for them to participate. And, currently you've got large scale financial institutions that are out there that are, kind of developing on, private permission blockchains. We talk about Canton in the, kind of report that Richard put out. And what you've got here now, and that's the first attempt, I think, at trying to really bridge that gap between how it is that large scale, institutions can work together to create solutions that'll, be industry-wide versus working in private permission blockchains, which is the advice that they're getting right now from the financial regulators, to protect data, to have the integrity of information, to protect for breaches and things of that nature. But at the end of the day, there needs to be some sort of a collective whole, and there needs to be standards, and there also needs to be, kind of a project or something that everyone is driving to. One last point on that, and I would say that, the Broadridge example that, Anthony brought up earlier, it's a great solution, but let's remember that that solution stops short of kind of a proper repo transaction because of the friction that exists between on-chain assets and off-chain fiat type rails that are out there right now. So there's a lot of bridges that need to be gapped here in order for these solutions to really be widespread and to be impactful as we all envision they're going to be.
JD, thanks. With the assent of the group, I wanted to bring up the next slide, but Richard or Jay, I wanted to give you one opportunity to speak to this last
I'd like to jump in on that last point. You're talking about kind of integration with TradFi. There was a question in this paper we did is like, how are we going to drive adoption? Is it going to be crypto companies on their own, TradFi companies on their own, or a combination of both? And I think 50% said it's going to be either a combination of both. Another 33% said TradFi companies. So all in all, you got 83% of folks saying we need the traditional finance companies to move this space forward, which is completely, makes sense to me and is in line with what we've been saying. And it's good to see folks like Goldman have launched their DApp product. Citi's got a dedicated team. JP Morgan's got their Onyx as well. Obviously, Jay's over at Stakes. It's great to see this. But these are, large SIFIs, basically, systematically important financial institutions, and they do take their time. So that moves more slowly, kind of naturally. But we've been at it for a while now, and we do see, we do see these things moving forward now.
Richard, thanks. I see Jay smiling as you finalize that comment. Jay, I do want to stick with that point for one more moment, and I want to talk a little bit about that. When we talk about large organizations like State Street, for example, is part of the concern also from an incumbency perspective, are we introducing new risks? And we certainly don't want this to be a technology or a product conversation, but certainly risk aversion is something you probably get stuck looking at every single day.
Oh yeah, it's well, we are a GSIFI bank, right? So it's something we're profoundly aware of. But I just want to touch on it early. But I mean, I think one of the issues when you see some of the successful proof of concepts that we've participated in, none of them have been around an actual underlying security instrument. It's really more about an infrastructure play like data. We were part of the iCapital one, and that was a very successful one using blockchain to share data. So I think that included ourselves and probably 17 others. But I also agree that I think, for the most part, the industry as a whole, the TradeFi, the incumbents need to be able to come up with a, what area do we want to solve amongst ourselves? What area should we go after now? Right? What can we solve ourselves? Because a lot of firms are trying to do this on their own. We know DAML tried to do in Australia. We know, we heard what the LSA wants to do, in London. But I think really when it comes down to the large incumbents, we really have to come up with a use case that all of us could participate in and feel comfortable with. But the other thing is can we do it on a private blockchain? No, we have to get the regulators comfortable with doing it on a public blockchain. So there are still some barriers out there, but we have dialogue every day with our competitors. We participated with them. We've done several proof of concepts with them, but I think it has to be a more targeted approach, kind of like if and Anthony made this point early. It's never going to be like it was in the 90s where we dematerialized, where the regulators said, here's the line in the sand, everything's going electronic. We have to do it ourselves in smaller portions and, slowly. And that's what I chuckled at. We take our time. We don't take our time. We look for risk excellence, right? We want to be able to do things because at the end of the day, we're also operating this large infrastructure that's 200 some odd years old, right? And we're we're not nimble, but we're careful. And that's really what it comes down to. We have to be careful and do so in a way that lets everybody here sleep at night.
It has to be an evolution, right, Jay?
Yes.
And Jay, what products do you think banks would most readily cooperate on? It's got to be something short term. It's got to be something that moves. So is it some kind of a cash product? Is it a repo? Is it an FX?
I mean, commercial paper has come up, right? Yep. Quite a bit because we all share commercial paper. There are a number of money market funds out there, right? So you see a lot of that out there. So it's really, like you said, a short-term type of liquid instrument that we could all share and work on, and then, move into another asset class. I've said private equity before, but private equity is there's so much friction in that market, and it's so diverse. Like you have lawyers with cap tables on Excel spreadsheets or notebooks, and then you have the more, you have the iCapitals, where things are very automated. So that market is the one that needs it. It's probably going to be the most difficult. But you're right. I would say probably commercial paper space, and money market funds, or even like smaller funds. We see mutual funds moving in that direction right now. Look what Wisdom Tree did, right? So I think that's really where you're going to see the evolution. And we talked to JD about what ARC has done with their blockchain funds, and I think that there will probably be, and I'm probably going way off script right now, I do think, Anthony, that it will be a new product that we could all work on. I think it's going to be a new product. It's not going to be crypto, right? It's just going to be a new product that we could all say, hey, this is going to be a native blockchain security, and we all want our clients to own it. We all want to service it, and that's probably what's going to happen. There's going to be something new out there.
Cap tables on Google Sheets. Where have we seen that before? I couldn't resist, Richard. I'm sorry. I want to share the last slide. I think it's important as we move forward. And again, everyone in the audience, thank you so much for the questions. Keep them coming. We'll address them as shortly. One other thing I want to talk about, as we had our conversations, colleagues, we had talked about challenges of tokenization, and one of you wisely called them myths. Richard, I'd love to start with you a little bit. Can you tell us why, in your perspective, some of these are myths, and how do we peel back the layers of some of these myths, and what does that mean for the marketplace?
Yeah, this is something that I think, a little kind of enhancement we added in our kind of pre-chat for this webinar here, is that we're looking at the number one, lack of regulated digital asset infrastructure for tokenized real world assets. Well, we've got Texture Capital, we're a regulated broker dealer. We're not the only one. There's a few others out there for digital assets. We're specifically focused on building issuance and secondary trading infrastructure. JD has gone through the whole registration process to issue their token for their interval fund. So it's doable. It's out there. We can do it. If you want to, you launch a fund, call up Arca Labs. They can help you do it. We can help you do it as well. It's new, it's different. So there's some different things to kind of understand, which is maybe where the second point comes in, ensuring compliance with regulations. But that is literally our job as a broker dealer. So again, we can help with that. So we think there's a lot of things, although these are perceived as challenges, they are very much addressable. I know I'm going to let some of the others jump in on some of these other ones.
Yeah, please. What were your comments or perspectives? JD, if I could, I'm gonna target you again, my friend. You did the most nodding so far. What were your thoughts on some of these myths/challenges around RWAs?
Yeah, I mean, I take a look at, let's even take, custodians, transfer rates, other required service providers can increase costs. I mean, I think that, I've been through the process with, multiple different service teams. We've been through the process, trying to understand where the efficiencies are. And we think that the efficiencies come with scale, right? I would say that 2 or 3 years ago, when you're dealing with things like, selecting a blockchain that would be acceptable to the regulator, I think that it was a very, very different conversation. We started in 2019. There were a fraction of the number of blockchains that were available at that point. So when we started the conversation, we were talking about Ethereum, and that conversation, we spent some time with the regulator, getting them comfortable with that and the attributes of that blockchain. Now if you fast forward 4 or 5 years and you take a look at kind of the number of blockchains that the SEC has permitted registered products to be issued on, it's far greater. When you look at the kind of costs to transfer on those blockchains, well, your gas cost isn't $7 or $10 on the Ethereum blockchain when you're dealing with Solana or Avalanche or other different blockchains that are out there. So I think that, again, when you talk about this being challenges or myths, I think you really do need to bore down and really understand that there has been an evolution over the course of the past, 6 or so years, since many of us began on this journey. And I think that a lot of these challenges really have started to become mitigated.
Yeah.
And I'll just throw in that you have to separate origination from distribution. So almost any asset can be originated on blockchain, right? You can be serviced on blockchain. Can it be sold and distributed on blockchain is another matter entirely. So again, it's also possible. So again, going back to Figure, they've been originating HELOCs and mortgages on chain for 4 years. Only really in the last year and a half have they been distributing the other side of they come in digital, they go out analog. And now, really, for the first time over the last 18 months, they're coming in digital and they're going out digital. So now you have a proper digital life cycle, and it's an evolution.
And Anthony, when you talk about that, I mean, I assume that there's cost efficiencies as well, right? For folks that are buying or selling those HELOCs, right?
So, to give a little TV commercial for Figure. So they're taking, almost 200 basis points out of the process of originating a home equity line of credit and going all the way through to a rated asset-backed security. So they've done 3 or 4 tranches already, or 2 or 3 tranches. Goldman, JP, Jefferies were the investment banks. BNY Mellon was the indentured trustee. And these are digitally native, originated blockchain securities, $200 to $300 million a tranche. So it's very, very real.
Awesome.
Gents, thanks so much. Any other comments, Jay, that you wanted to see it make on this particular slide when you saw the myths and challenges?
Yeah, this slide is clearly where people are conflating the crypto market with the traditional market, right? Because in the case of most of these, custodians increase costs. Well, yeah, if you're a custodian of Bitcoin and charging 20 bips, absolutely, you don't get 20 bips for traditional assets, right? And even transfer agency is basically a commoditized business. So in effect, lack of ensuring compliance, smart contracts solved with that. Lack of high quality assets. I agree with that, but I think the answer to this part of the survey where people are like, well, the crypto that's out there right now is not high quality. So I think really this is a clear case of education, being clear to the market what the differences between tokenized assets and crypto assets is very profound. There's a huge chasm between the two. And I think that's really what we have to get to, the point where people understand that what you're seeing in the crypto market is not what you're going to see in the traditional market.
Yeah. Excellent. Thanks, gents. Let me stop the share here and get us all face to face. We've got a bunch of questions. And again, for those of you in the audience, we'll make the deck available to you. post this, and also we are being recorded, so the video will be available for everyone later on as well. Gents, I want to wrap with one question that's not that's more directly tied to our experience within organizations. We've all worked at organizations large and small, and one of the consistent things we've all seen, and we actually spoke about previously, was internal support is always a challenge, particularly with big firms. How do we answer colleagues that are in this space or want to drive their firms into their space when they say there's no internal support for an initiative like this? Again, taking a little bit off the cuff, but how do you answer a question like that from colleagues in the industry? Does anyone want to start with that? That was way off script, Richard, by the way.
I can't answer that because I'm not in a big organization, so I'm waiting for someone called Jay to maybe.
Yeah, it pretty much was right at me. Listen, there's no lack of support, right? We have a ton of support, and we have a ton of enthusiasts at State Street, right? So you think about our group as digital is small, but the groundswell of support is large. It really comes down to a choice, right? So a large organization such as ourselves, I said earlier, has a business that we're in, right? And we're not that nimble, right? We want to do 1,000 things, but we have to focus on what we can do. And it really comes down to resources. And as a public company as well, you're also, you're tied to coming up, with making sure that your revenue is there and you're investing in the right projects. And for us, we have, it's from the top down, right? From our CEO down, our head of product, Donna, they all support us and they rely on us to come up with the right projects. What we really have to do well in an organization like ours is pick the right use case and do so in a way that is scalable to our other clients. We have a number of use cases that we look at every day. We have a number of clients that are looking to do things with us. We want to make sure whatever we do here, one, does not get in the way of business as usual. Two, is done in a way that mitigates as much risk as possible. But three, does so in a way that actually expands our business going forward. And I think really that's why whenever I have these conversations, it's to us, we have, $33-40 trillion of assets under custody. We need to increase that, right? Crypto is not going to increase it. If crypto prices triple tomorrow, we'd have 3 trillion in assets, right? We really see, one, the assets that we're custodying tokenized. We have to be able to defend that and service that. And two is open up these new markets. And that's why we get excited about real estate and private equity. And you see the numbers. There's 150 trillion in assets, right, available. Will all those be tokenized eventually? Not in my lifetime. But if you take even 10% of that market, it's a big opportunity. And that's really what we have to do, is weigh those opportunities versus what we can do for our clients today.
I want to jump on that a little bit if I can. Sorry, Ron. Is that
no? Go for it.
I think what you said makes a lot of sense. As a large organization, you need to look at what makes sense from a risk perspective, what makes sense kind of synergies with other types of the business. I'm not going to pick on you too much here, Jay, but I've been surprised by how a lot of institutions, when they're deciding what they wanted to do, large traditional ones, when they want to get into digital assets, so many of them decided it was going to be crypto custody. State Street, BNY, Fidelity, NASDAQ. I don't know where you guys are on the custody. I think maybe pulled back to a certain extent. I don't know if you're completely out of it. NASDAQ has given up on the crypto custody game. And like you said, it's a $1 trillion asset class. It's not necessarily, a lot of synergies with the other types of assets that are being custodied by these entities. And you've got a much larger opportunity with more synergies around tokenization of securities and so forth. So that is something, and also, not for nothing here, when it came to, let's say, the BlackRock ETF and where they were going to do custody their crypto, who did they choose? Not Fidelity, not BNY. They chose Coinbase. So, it seems like there should be a rethink from some of these incumbent players on where they're, putting their dollars and putting their bets.
Well, let me answer that. My twice erstwhile colleague, Richard, we see it as Normandy Beach, right? It's a starting point, right? So we need to build custody for digital assets. The starting point for us is Bitcoin and ETH and, other crypto assets. So we don't see it as, finite. We're just going to do this. It's a starting point. We are already talking to our, technology people about being able to custody and service tokenized assets. So we're not in a box here, right? We do want to be able to serve. Listen, I'm not going to turn down business, right?
Yeah.
But we also want to be able to expand that business. And, Bitcoin and ETH, Coinbase, Gemini, they're in that business right now, right? If I'm buying Bitcoin, I'm not going to some guy who's doing it in the garage. I'm going to Coinbase, I'm going to Gemini, I'm going to the established players, right? So that's what you're seeing in the market. And that's probably not going to change for for at least, a couple of years. But when you have clients that need to work with a qualified custodian and they want to get into this asset class when it is approved, they're going to be looking to us. And that's what we're looking to build. And then once we have that, foundation, all subject to regulatory approval, let me put that asterisk in there, then we'll be able to bring on other assets, right? And that's really what the goal is for us. And we'd love to be able to, work with third parties such as yourselves to provide that solution.
Jay, I feel like Richard queued you up for a sequel to this webinar at some point in the future. So everyone stay tuned. We've only got 4 or 5 minutes left. Gents, again, thank you so much for the thought leadership. I want to address some of the questions that we've got. We're not going to be able to get to them all. Shout out to Stephen Rutenberg, our old friend at WSBA member. When you consider something to be quote unquote tokenized, does it need to be a decentralized blockchain? Can most of what you are dealing with happen on centralized, faster systems? We spoke to this a bit. I'm going to wait for someone to raise a hand before I call on them. Who wants to kind of tackle Stephen's perspective on that?
Yeah, I'll take a shot. So the way that we look at things is on one side of the paradigm, you've got completely open, permissionless blockchains, Ethereum and other public networks that we know so well. On the other end of the paradigm, you've got the DAMLs and the R3s, the private and permissioned blockchains, and neither are perfectly appropriate for financial services, right? You can't have a completely open construct where all data is everywhere and everyone can read it because we're financial services and we need more privacy than that. You can't have completely closed ecosystems as well because you miss out on the innovation of blockchain. So we operate in a hybrid mode at Providence, somewhere in the middle. We call ourselves properly permissioned, and we get the innovation of the Cosmos ecosystem, which has 1,000 engineers working essentially for free on our network, which is great. But we have a whole bunch of controls in place that make us more centralized than a typical blockchain. And I think that's where financial services lies. Now, I'll say our chain is not appropriate at all for crypto trading or NFTs or gaming or metaverse. We're inappropriate for those. But financial services is different, right? And I think that's where we sit.
Anthony, thanks. I want to move forward with some other questions. I want to skip a little bit just to get some more important topics. Love the eventual overlap of DeFi lending and tokenized assets. Paul Gaffney writes, in the interim, are you working with any traditional yet forward-looking lenders that are happy to manually lend against tokens? I hold the tokens and get their teams familiar with the technology. Interesting perspective. I'm not sure who'd best for answering that. Anyone interested? Okay. Peter, reach out to us. We'll connect with some colleagues at the firm, at the organizations that we're talking about here as well. Could the panelists talk a little bit about the liquidity challenges financial institutions face today and how tokenizing assets might eventually provide improvement in liquidity? Jay, I got to argue this is something you think about as well on a regular basis.
Yeah, I mean, we mentioned private assets, right? Liquidity in private assets is obvious, right? So we think that tokenization would be able to allow for a new constituency to come in. If you think about, people that are trading crypto assets in Coinbase, 20 some odd million, right? So in effect, accessing that liquidity market, right, is something I think every private equity investor would love to do. So I really think that there's an opportunity to take, tokenized assets, do so in a way that opens it up to not only the traditional constituency of institutional investors, but this whole new constituency that are investing in crypto assets. So certainly, I think it will help, and that's the primary use case for us is to be able to offer those assets in the secondary market. When I mean us, I think everybody here. I'm not talking specifically State Street.
Understood, Jay. Thanks so much. Really appreciate it. Shout out to Bill Karsh, who joined us. Great to hear us today. With very few trust banks being approved to hold collateral, firms like Anchorage can pick winners and losers. Bit provocative. What can you do about expanding to allow digital broker-dealer ATSs to work? Kind of deep diving on some market structure stuff, but JD, I'd love your perspectives, or anyone else wants to chime in.
Yeah, I mean, I think Anchorage finds themselves sitting in a little bit of unique position, right? I think there's a couple of folks that are out there that have found, carved out niches for themselves. Another one I would say it's probably more controversial would be like Promethean, right? Who's, received a license for a special purpose broker dealer as well. I think that, speaking about Anchorage specifically, I think that they've got an opportunity really to advance the entire marketplace if they should so choose, right? They've got the ability to custody digital asset securities. That's something that, the qualified custodian, role right now, I think, although we didn't talk about it extensively here, is something that's super critically important for this marketplace and identifying who it is that can custody in a way that conforms with the way that regulations have been, set forth. And what do those folks look like? Is it a bank or is it other folks, right? Obviously, folks are well aware that a good control location can be found, in unlikely places like at the TA, but like at the end of the day, is that really the place that folks need to go in order to find a qualified custodian? So, I think that Anchorage has a massive opportunity here. I think they've got a great opportunity to lead. They're one of the few, folks that, when you talk about that new wave or that new generation of different market participants that have an offering that, kind of comes close to what traditional firms have.
Yeah. Gerald, JD, thank you so much. We're just about out of time. Anthony, Richard, Gerald, Jay, always a privilege. Really appreciate the thought leadership. We'll end up probably doing this again, probably before the end of the year, given the way that the market's evolving. Again, for all of you in the audience, thank you for joining us. We'll have the recording publicly available as well. If we didn't get to your questions, email us info@wsba.co. We'll get you out to these thought leaders. Gents, again, thank you so much. Really appreciate your time.
Thanks for having us.
Thanks,
everybody.
everyone.
Everyone, cheers.